We're here today to talk about insurance companies profiting off of money owed to families of fallen soldiers, airmen, and seamen, and veterans. For some time, insurance companies have made a practice of placing money owed to beneficiaries, that is, family members of slain loved ones who have a right to disability insurance, taking those benefits and putting them into what are called retained asset accounts or checkbook accounts, often without the knowledge or the consent of the family member of the veteran. In doing so, insurers are able to pocket the difference between the interest rates they pay on these accounts and what they make in investing this money. And at the end of the day, it means less money for the family members of the slain service member. Recent news reports indicate that insurance companies have pocketed 4 to 5%, while the families were paid substantially less interest. The news reports also say that more than 100 insurance companies could be retaining and earning investment income on $28 billion owed to life insurance beneficiaries. Particularly disconcerting are the profits made from these retained asset accounts that hold death benefits from policies of slain service members. Profiting at the expense of family members of service members who paid the ultimate price to our country is simply outrageous. Also troubling is that these same retained asset accounts or checkbook accounts are not insured by the Federal Deposit Insurance Company, which means if the asset goes bad, the beneficiary, the family member, doesn't have recourse to getting that money back. I've written the Insurance Commissioner, Steve Poizner, to investigate this matter as it relates to California companies. But in addition, today I'm announcing the introduction of legislation that's designed to protect the family members of our slain service members. Today I'm introducing Assembly Bill 786. This bill establishes significant protections for beneficiaries of life insurance policies. The bill requires that the insurance companies wishing to continue to use these retained asset accounts, rather than just simply throwing the money into the asset accounts, that to do a number of things to inform the beneficiaries that they're opening these accounts. First is they have to obtain the approval of the beneficiary before they open the retained asset account, instead of just throwing the benefits into such an account. They have to disclose to the beneficiary that there's no obligation to accept a retained asset account. You have choices. You don't have to put your money into the insurance company's account. You can take the benefit and invest it as you see fit, put it into a higher interest-bearing checking account or savings account or any other financial instrument. The bill also requires a disclosure that these retained asset accounts are not insured by the FDIC, which is an important protection not available to folks whose benefits are placed in these accounts. And finally, the bill requires that all interest received by the insurer for the benefits that are in these accounts be paid to the beneficiary less any reasonable administrative fee. So that takes the profit incentive out of these arrangements.